You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to OIC's Wide World of Options. I'm your host, Mark Benzaquen, and for today's two-part episode, we're first going to take our Wayback Machines to our college statistic courses and discuss probability, tail risk, and standard deviation. And then we're going to close out today's session with a visit from Dr. Ellman of the Blue Collar Investor Corp. I had the privilege of sitting down with Alan recently at an industry event in Las Vegas, and we talked about his bread and butter, which are covered calls, cash-secured puts, and the teaching of which have made Alan one of the leaders in the options education space. So with that being said, let's go ahead and kick things off by welcoming my first guest, my friend, my OIC colleague, Mat Cashman. Matt, welcome back to Wide World of Options.
Thanks for having me, Mark. It's a pleasure to be here. I am excited to talk about options again today.
Excellent, Matt. So let's go ahead and kick things off. Something fundamental when it comes to options, Delta. Roma last month in her webinars talked about Greeks in depth. So when it comes to Delta, one of the things that we were talking about last month was how investors might use Delta as a measure of probability. What are your thoughts on that?
Yeah, I think it's important when you talk about that to really talk about what Delta is to begin with, right? So Delta is the measure of the sensitivity of an options price to changes in the price of the underlying asset. It's essentially the rate of change of the options price with respect to changes in the underlying asset price. So Delta ranges from 0 to 100, or oftentimes it can be expressed as 1.00. It's positive on the call side, and it ranges from negative 100 or negative 1.00 up to 0 on the put side. A delta of 0.5 or 50 would, for instance, mean that for every $1 increase in the underlying asset price, if we're talking about a call, that call's price would move up by 50 cents, all other things being equal. Now, traders often use delta as an approximation of the probability of an option expiring in the money, just like what you said as far as you talked with Roma about this last month. Higher delta values generally imply a higher probability, or at least a higher perceived probability by the marketplace, of that option finishing in the money at expiration. Now, this metric is particularly useful for traders when they're evaluating different strike prices and possibly maturities for option strategies, which sometimes can allow them to tailor their positions based on their outlook and their risk tolerance and be able to match those personal expectations with the expectation that the marketplace is kind of telegraphing to them through metrics like delta, especially when you view it in this way as a perceived probability of finishing in the money.
Right. So the traditional definition of delta for most people is the perceived move or the anticipated move in the value of the option as it correlates to the price of the stock. But there are also other definitions. The secondary definition we're talking about, the probability of the contract finishing in the money. Now, something that I like to make, which I feel is an important distinction, that there's a difference between probability of finishing in the money and being profitable. So just because it's got a high delta and it's got a high probability of finishing in the money doesn't necessarily that the investor is going to be profitable on that.
Yeah, absolutely. I think that's a really good distinction to make, and it's something that in a lot of the literature that I look at and see from an educational perspective, many times those two things are kind of cross-referenced in a way that is not always accurate. So I think it's important to make that distinction, especially when we talk about it from our perspective, from our seat as educators. We like to really make that distinction and draw that line in the sand to make sure people don't accidentally mistake one of those concepts for the other.
Right. In 80 delta, I'm going to make money on this. Not necessarily the case.
Yeah, exactly.
Excellent breakdown, Matt. Thank you. One of the other things that you're going to be talking about in your upcoming webinar, and something that was hammered home to me back in college, my statistics courses, was standard deviations. How do traders utilize standard deviations when it comes to options trading?
Yeah, I think that's a good segue there. I think standard deviations, generally speaking, are, when you learn it in a statistics course, it's the actual statistical measure of the dispersion of prices or the variability of a set of values.
All right, now let's say that in a non-professorial way.
Right. So if we take that down a level from Statistics 101 class into kind of regular speak as far as options are concerned, standard deviations are often used to gauge the potential range of future prices for an asset. Okay. Now, you can apply that to both underlying prices, you can apply it to option prices, you can apply it to really any set of data that you're looking at and trying to forecast the future of what that data might be. So in this case, standard deviations can be used in lots of different ways. Now, let me give you an example. Some traders like to look at something called Bollinger Bands. Bollinger Bands are basically just a set of potential prices for an underlying that are then overlaid on top of a graph and give you an idea of theoretically how far away from a moving average the current price of that underlying is. So in essence, Bollinger Bands are just the utilization of a simple moving average having some duration to it, 10-day moving average, 50-day, whatever. But then what it does is it basically usually adds two standard deviations up and two standard deviations down to the downside, and which create generally the actual range of prices that are used for that Bollinger Band. That's one way that people might be able to kind of draw a parallel with what they see on an everyday basis and how standard deviations are actually used. Now, that's not the only way that people use them, right? I think standard deviations and an understanding of them is a really integral part of understanding how options, and particularly implied volatility, works within the option pricing model. Standard deviations, and we've gone into this previously with something which we call the rule of 16,
right?
Which is actually deriving a standard deviation or an expected amount of movement on a daily basis from an implied volatility metric, right? And that we're not going to talk about that now. And if you want to look into that or learn more about that, we have some educational assets on our website that apply to that. But it's really just using standard deviations is a great way for people to understand and give a real hard metric as to what kind of price variability they can perceive of or think about going forward with an asset's price.
Okay, excellent. Fascinating stuff. And certainly on the surface seems much more maybe complicated than it really is. So I like that you tied this back to the website, because we do have a lot of content on there that help investors make a little bit more sense. Now, we've got the standard deviation, the ends of those deviation. If you think of a bell curve, again, from our college statistics class, the very ends of it to the upside and to the downside, those are called the tails and tail risk. Why don't you explain a little bit about what tail risk is and why it should matter to investors?
Yeah, I think that's great. The what you refer to as kind of a bell curve.
Right, a normal distribution.
Yeah, we think of as a normal price distribution. It's just the distribution of prices using a randomized idea going forward. If you assume that, Brownian motion is part of how the actual market works, that you would expect that there would be some sort of normal distribution curve to the actual prices of the underlying. Tail risk really refers to extreme or unexpected events that fall outside of the range of normal prices.
Right, like those black swan events we hear about.
Indeed, yeah. I think the black swan event, a lot of people look at things that are written by a guy named Taleb, who talked about things like that, right? If you have black swan events, they are multiple standard deviations outside of the normal range of price distribution. Mm-hmm. These events, and the reason why we talk about them in our context, can lead to significant losses for people that are carrying underlying equity positions, right? I mean, options, I think, provide a way to be able to hedge for those tail risk events. Things like downside puts, right? Protective puts are a way that people actually utilize those options to hedge out those tail risk events, potentially when you're talking about downside puts, to the downside, right?
Right. That's what I was going to, mention or interject, those downside puts. That's the reason that, we have skew, because, years ago when we had the market crash, we saw that that protection was costing more for the downside than the ability for the stock to go up, for example. So the relationship between out of the money calls and puts got, skewed, for lack of a better word.
Absolutely. And I've done a presentation on skew before on the OIC webinar. There's also, if you have questions about skew, make sure to get in touch with us and send us email questions at options@theocc.com, because we love to talk about skew. The reason why skew exists is because of that kind of slightly skewed distribution of prices, and people look at it and look at the movement to the downside historically in equity prices has been more violent than the move to the upside. And thus what you get is exactly what you just referenced, which is those puts become theoretically more valuable or perceived to be more valuable by the marketplace, and thus are priced higher than the commensurate upside calls are. But as far as hedging tail risk, people use things like downside puts. There's another way that people can actually utilize options in that regard, and it utilizes the actual downside put, but also there's another strategy that we've discussed multiple times, which is often referred to as the risk reversal or the combo or the protective collar. Lots of people have different, words, nomenclature for it, depending, and a lot of times it depends on which actual asset class you're using. The funny thing about options is that different asset classes have different words to describe the same option strategy, right? If you're talking about it in the equity market, it's called a risk reversal. If you're talking about it and you're trading euro-dollar options, they call it the combo. But if you talk about the combo in the actual equity options market, people think you're talking about the actual synthetic stock position that's created, right? So But that notwithstanding, there's a lot of different ways that you can use these downside puts, or what I like to refer to as the risk reversal, which is you would have the same position in the downside put, you'd be long the downside put, but then you incorporate the upside call and you sell the upside call against that downside put, which creates this combo or this risk reversal position. And what that essentially does is it utilizes the premium that you're collecting from the upside call by selling it to offset the cost of that downside put. Now, many times when people have this position, they do it against an already pre-existing long underlying position. So it's important to remember that even when you're hedging tail risk like this, that you can't fully take your underlying position out of the equation, right?
Right, certainly.
Yeah, you're still long the stock, but what it does is it gives you some flexibility as far as being able to potentially exercise that put to the downside if you were actually to go through that strike and it became economically advantageous for you to do that. And the ability to actually offset the cost of that put by selling the upside call against it. So that's another way that people can actually hedge that.
Excellent insight, Matt. Thank you. So in understanding of delta, standard deviations, tail risk, et cetera, is going to be crucial for options traders and in assisting them to make their decisions. So let's go ahead and take a deeper dive into each of these, if you could. If you could elaborate a little bit more on the nuance of delta and how traders might use it.
Yeah, absolutely. Delta is one of those things that you can look at it in lots of different ways. We've given you a potential way you can look at it as a measure of the market's expectation for that option being in the money at its expiration. But it's also important to realize that delta is a dynamic thing and it moves just like other risk parameters move as option prices move. And so delta is one of those things that it's sensitive to an underlying asset price and also other metrics, things like implied volatility and time can affect how much delta an option has. It's important to understand how delta and time are related. As time comes out of options, in the money options become more in the money and out of the money options become more out of the money. And so because of the fact that options can only be bound by 0 and 100, an in the money option will tend more towards 100 as you pull time out of it, and an out of the money option will tend more toward the 0 bound as you pull time out of it.
And what you mean by pulling time out of it, you're simply saying as the days fall off the calendar, we approach expiration.
Absolutely. Yeah, that's what I mean. And the more that you understand about how time and actual duration works, as far as, and additionally implied volatility of those options, as far as the delta is concerned, the more you're going to be able to find the option that best fits what you're looking for and what your risk tolerance is. It's important to understand that delta is dynamic.
Certainly.
And that it changes, right? And so it's something to keep your finger on the pulse of what the delta of your position is, because especially as you start moving those things around, your delta is going to be dynamic just as you move things, and also it's going to be affected by the underlying move as well. So it's important to make sure you keep your finger on that pulse as well.
Right, certainly. It's going to require monitoring, right? Just like anything else in options, it's not necessarily a set it and forget it kind of product. You need to stay on top of it. You need to stay vigilant. And the deltas, as the stock is going to move, your risk is going to move with that option position as well. So, yeah, it's definitely something that you need to keep your eye on. Let's go ahead and get back to standard deviation, if you don't mind. How do traders use that to assess volatility, for example?
Yeah, I think it's important to talk about standard deviation relative to what we refer to as historical volatility and how that ties into implied volatility. Generally speaking, standard deviations, and what I said before is that we have some educational assets that give you an idea of how you can actually derive a standard deviation value from an implied volatility level. Implied volatility levels of options are oftentimes tied to the actual historical volatility of the underlying. It's not absolutely, there's no, the R squared isn't 100%. It's not fully tied to it, but it's like, a lot of times when you see things that have exceedingly high historical volatility levels, meaning that the underlying is moving around an awful lot, you will sometimes see the actual implied volatility levels moving up in sympathetic moves to that because of the way that options are priced relative to the underlying movement. But as far as the actual standard deviations are concerned, what that means is that generally speaking, traders who are looking at implied volatility levels as a metric that actually mirrors the movement that's happening in the underlying marketplace are going to know that the actual standard deviation or the larger, the range of prices moving forward are going to be slightly larger in both directions because of the way that implied volatility works, and that standard deviation is going to be larger. What a lot of times people will do is they'll actually utilize the standard deviation numbers to actually guide them as to potentially what strikes they might use.
Certainly, standard deviation can provide valuable insight into volatility, help traders adapt to their strategies, et cetera. Speaking of strategies, you had mentioned strangles. What other strategies might traders look to that might be designed to manage tail risk, for example?
Oh, that's a good question. The whole gamut of strategies can really, you can tailor them to potentially, hedging different tail risks. But a lot of times what people will use are strategies that incorporate both at the money and out of the money options within those strategies. So things like iron condors or things like butterflies or different ratio strategies that have what we call wings, right? These out of the money options, and utilizing them versus the at the money options, right? But what you end up really doing is trying to conceive of what your risk is relative to those kinds of positions and trying to kind of extrapolate from your position that's been in effect given to you by the market as to what kind of risk you're carrying and what you might be able to characterize that as, right? We would look at it and say, oh, this looks like we're long the 10, 20, 30, 40 condor. And what that does is it allows you to actually look at that position and think about it in a much more kind of general way, and it allows you to zoom out a little bit and be able to not think about like exactly what those strikes are, but more generally like how does this act? What does this look like from a risk perspective, and be able to evaluate your risk in a much more holistic way like that, right? I mean, that's one of the things that we use those things for. Yeah,
excellent information. Thanks for sharing. Absolutely wonderful. Listeners, I want to encourage you to attend Matt's 2 upcoming April webinars. You can do so to register via the events section of our OIC website, optionseducation.org. And as Matt is one of our top presenters, I definitely want to encourage everyone to register, as Matt's going to be talking a lot more about tail risk, standard deviations, delta probability, et cetera. Sure to be a very informative, very engaging presentation. So I want to encourage everyone to register for that, please. And Matt, I want to thank you for joining us today. This was a lot of fun.
Absolutely. It's always a pleasure to be here. I hope I get invited back.
Well, we'll see about that. Now we're going to listen into a conversation that I recently had with Dr. Ellman of the Blue Collar Investor Corporation. Ellman has been a friend of OIC's for years, and I recently caught up with him at an industry trade show in Las Vegas where we talked about the value of education in the options space, common mistakes investors might make, and how Ellman became one of the leaders when it comes to talking about covered calls and cash secured puts. So let's go ahead and listen in now. We are live from the expo floor of the Money Show Las Vegas. I've got a very esteemed guest with us, Dr. Ellman of the Blue Collar Investor Corp. Ellman, thanks for stopping by. I certainly appreciate it.
My pleasure, Mark. Nice to talk to you.
Always, Ellman. Thank you. Ellman, you're going to be talking about covered calls and cash secured puts. That's kind of your wheelhouse, your bread and butter. Let me ask you, when it comes to education, when it comes to speaking with your customers, do you find that there's a certain mistake or some misconception that they're making time and time again? Do you find that there are certain problems that people run into normally?
Yes. As a matter of fact, when I do my presentations, one of the issues that always concerns me is that a lot of the attendees are so excited about these strategies that can generate cash flow on a weekly or monthly basis that they want to get started like tomorrow. And I tell them that it takes some time to master what I call the 3 required skills necessary to achieve the highest level of returns. And those are, what underlying security are we going to select? Could be a stock, or it could be an exchange-traded fund.
Okay.
So that's one. Number 2, what option are we going to sell? And then number 3, how do we manage our trade? So stock selection, option selection, and position management. And those that are just starting out need to take months before investing even 1 penny of their hard-earned money. So that is one of the mistakes that I see covered call writers make, is they don't take the education as seriously as they should, whether it be through my venue or the Options Industry Council, which I leaned on quite heavily and still do for education.
Yeah, thank you. So obviously people need to learn how to walk before they run. Learning about the ins and outs of covered calls, learning about assignment, learning about risks in pricing, et cetera. So you're thinking that people really need to educate themselves first before they're putting their hard-earned dollars, down on a trade.
They have to do their due diligence first. It'll be well worth it in the long run. I tell people all the time, invest 3 to 4 months in the education, paper trade, practice with hypothetical portfolios, iron out the wrinkles. I didn't get to where I am today by not educating myself. Now, I was self-educated along with assistance from the OIC, but it took a while. And now that I've experienced almost 30 years of covered call writing and selling cash secured puts, I can get people from point A to point B.
Right, okay. So you're talking about a 30-year track record. Obviously, you've got the designation doctor. You've earned your doctor, your medical license. Tell me about that. How do you go from being a dentist to a covered call guru?
Well, actually, Mark, I had a pretty good gig as a dentist from New York. I had a partner in a practice of 15 employees that worked for me, which included 4 dentists and 3 hygienists. So we had 9 producers altogether. So I was able to work a 25-hour work week and still support my family comfortably. However, in the 1990s, I realized that at some point in time, I would need a passive form of income, and I had no clue how to self-invest. So I decided that I was going to teach myself how to invest in the stock market, which ultimately led to options, and in the real estate market. And I always had a bit of a knack for math. I started developing various formulas, rules, and guidelines, algorithms, calculators for both. And then what happened, Mark, was in 2006, I was invited to speak before a real estate investment club of 250 investors and about some deals I was doing in Austin, Texas. And during that presentation, Mark, one sentence came out of my mouth that was about to change everything for me.
Oh, interesting.
Including my career.
Okay.
I said to the audience that I purchased my first investment property with the profits I earned from selling stock options. Well, after I went through this whole real estate presentation, people were coming up to me saying, "How do you do that stock option thing?"
Oh, that's funny.
And then I started getting emails and phone calls. So I said to my wife, Linda, maybe I should write a seminar. So I wrote a seminar. I rented out a room in the local Holiday Inn. The woman who owned the real estate club was very generous, allowed me to send out an email blast, sold out.
That's great.
And then I wrote 3 more, advanced, and then ultimately that led to the publishing of my first book, Cashing In on Covered Calls, which went right to #1 on Amazon on options at that time. And here I am today, having recently published my 9th book.
Wow.
And invitations to speak all over the country.
Yeah,
So you never know,
excellent.
Mark. You never know.
That's excellent. Interesting story. I love that. Thank you for sharing that. Now, speaking of covered calls, that's, as we had mentioned, that's your bread and butter, that and cash secure puts. For investors that maybe are just getting into options and maybe not so familiar with covered calls, can you give us a bird's eye overview of what they entail and what they're all about?
Sure. Let me first start with breaking down the three words in the term covered call writing, and then I could, if it's okay with you, Mark, set up a hypothetical example to kind of make everything come alive.
Perfect.
Covered means that we know our cost basis. We buy the underlying securities before we sell the option. Call is the type of option we're selling. So we are agreeing to sell our shares at a certain price called the strike price that we determine by a specific date known as the expiration date that we determine. So we set the parameters of the contract. Now, let me set up for you a hypothetical example. Let's say we buy 100 shares of stock at $48 a share.
Right.
Now, the reason I say 100, Mark, is because one options contract involves 100 shares of that underlying security.
Right, typically, yes.
So for every one contract we sell, we must first own 100 shares of that underlying security. I'm talking now 99% of the time.
Right.
So our cost basis is $4,800. 100 shares at 48 is $4,800. Now we are covered or protected. We own the shares. Now we are free to sell the option. So let's say we sell a $50 call option, higher than the current market value. That's called out of the money. Now let's say we generate a premium of $1.50 per share, or $150 for the 100 shares, or for the contract that we sell. And now, if that underlying security is more volatile, the premium would be higher. If it's less volatile, the premium would be lower. But this is a good kind of in between.
Right.
So we generate $150 in cash the instant we click the button on our computer and the trade is executed. $150 per contract is generated into our cash account. Now, we are obligated to sell our shares at 50 at any time until contract expiration. If we sell a monthly contract, it expires the third Friday of the calendar month, most of the time, 4 p.m. Eastern Time. Now, there are two possible major outcomes. Let's assume for a moment the price of the stock does not supersede that agreed upon $50 sales price. Why would the option buyer exercise that option and buy our shares for 50 when they're trading at market at a lower price? Not going to happen.
Right.
So the option expires worthless. We still own the shares. We generated the $150 per contract, which is ours to keep no matter what, and now we're free to sell another option in the next contract cycle. The second possible major outcome, and I'm setting aside exit strategies because there are 14 different exit strategies we could use for covered call writing, but let's assume we don't. The price of the stock does in fact move higher than 50, even by a penny, at expiration, and we take no action to buy back that option. Well, our shares will be sold the next day, that Saturday after expiration Friday. You'll go to your brokerage account, you'll see shares are gone, and the cash is in your account, $5,000 per contract. Now, we generated $150 on the sale of the option, plus another $200 on the sale of the stock, 48 to 50 times 100. That's a $350 profit, realized profit, on a cost basis of $4,800. That's better than a 7% 1 month return. Now, Mark, before everybody in the audience gets super excited.
All right, here we go.
Let me tell you, there is no strategy that is without risk.
Right.
So in that hypothetical, if the price of the stock moves below the break-even price point, which is $46.50, the $48 we paid minus the $1.50 in premium, we can start to lose money. And that's where that third skill set of position management comes into play. And as I alluded to earlier, we have 14 different exit strategies for covered call writing that can help mitigate losses, turn losses into gains, or even enhance gains to even higher levels.
Yeah, that's excellent. Thank you. A very wonderful example, very succinct description of one of the most popular strategies out there. Certainly appreciate that. Ellman, before I let you go, let me ask you one last question if I can.
Sure.
You've been a options mentor for 30 plus years, speaking with thousands of investors around the world. What is your favorite thing about education, about teaching these people, what you know? What gives you the most satisfaction?
The testimonials. I am humbled by the email testimonials I get from people from all over the world. Mark, I could never have imagined that I would have members of the Blue Collar Investor following me from countries, dozens and dozens of countries outside the United States. And when what I teach makes a difference in their lives, a lot of them will send me an email. I print out every single email testimonial. I have binders and binders of them in my house, and this is what keeps me going.
That's great.
And that's why I can never see myself stopping what I'm doing now. It's just, I feel like I'm one of the luckiest people in the world that have had an opportunity to have had two careers that I absolutely loved, where I got such great feedback from those around me. And so I'm actually humbled. But that, to me, the feedback I get from people that have benefited, even in a small way, is what keeps me going and is one of the highlights of my life.
Yeah, it's nice to know that the efforts that you do are appreciated and impact people in a real way. Yeah, that's wonderful. So no chance of going back to root canals anytime in the near future.
Well, if you open wide, I'll let you know.
Ellman, thank you so much. Thanks for visiting us here at The Money Show. Always great to see you, sir.
Thank you, Mark. Appreciate it.
All right, we'll see you soon. Thank you.
Yes, sir.
That's going to do it for today's episode of Wide World of Options. Thanks to my in-studio guest, Mat Cashman, and to our friend Alan Ellman for all the great info and insight they shared with us today. And thanks again to all of our listeners and supporters out there. As a reminder, please be sure to register for Matt's upcoming sessions on probability and standard deviation. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Take care, everyone, and we'll be talking with you again soon.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.